Hey everyone, and welcome. Ever looked at two companies that seem identical on the surface, but their financial reports tell completely different stories? Well, today we're diving into the reason why. Accounting policies. Think of them as the specific rules each company decides to play by. It's a fascinating topic, so let's get right into it. So here's what we've got on tap. First, we'll nail down what these policies actually are. Then, we're going to look at the key principles that guide a company's choices. This is super important. We'll also cover why changing a policy is such a huge deal. And then, of course, we'll wrap up with a quick recap and a little quiz to see what you've learned. Okay, let's start with a little puzzle. Imagine two businesses, right? They're perfect clones. Same products, same sales, same costs. So how on earth could one of them report a massive profit while the other reports a loss? The answer isn't some kind of financial magic. It all comes down to their choice of accounting policies. To really crack that puzzle, we've got to get to the heart of it. What exactly are accounting policies? Let's break down the official how-to guide for a company's finances. So here's the formal definition. Accounting policies are basically a two-part deal. You've got the principles, those are the fundamental rules of the game, and then you have the methods. That's how a company actually applies those rules in real life. It's kind of like this. The rulebook might define what a foul is in basketball, but the referee's judgment call on a specific play, that's the method of application. And this is where things get really interesting. There's no one-size-fits-all rulebook here. I mean, think about it. The needs of a brand new tech startup are totally different from a 100-year-old manufacturing company, right? This means management has to use its professional judgment to pick the policies that truly reflect their unique business. Let me give you a couple of solid examples. Take inventory, just how a company values the stuff it has on its shelves. It could use a method called FIFO, which stands for first in, first out, or it could use an average cost method. That single choice is an accounting policy, and believe me, it can make a big difference to the final profit number. The same thing goes for how a company values its investments. Each choice paints a slightly different picture of the company's health. Okay, so if companies have all these choices, what stops them from just picking the policies that make them look amazing all the time? Well, it's not the Wild West. Their choices are guided by three absolutely fundamental principles that keep things fair and honest. And getting this right is a really big deal. A bad policy choice can make a company look way more profitable than it is, or it could hide some serious problems. The ultimate goal always is to present a true and fair view of the company. It's about being transparent, not just crunching numbers to get the result you want. First up is the principle of prudence. The best way to think about this is sensible caution. You have to account for potential future losses, but, and this is key, you can't be so pessimistic that you start hiding profits to create a secret reserve for later. It's all about being realistic and exercising caution when you're making estimates. Next, we have substance over form. Now, this one is really fascinating. It means an accountant has to look at the economic reality of a deal, not just what the legal contract says. So if a transaction is structured to look like a sale on paper, but in reality it functions just like a lease, well, you have to account for it as a lease. The truth of the transaction is what matters most. And our third guiding principle is materiality. This one boils down to a simple question. Is this piece of information important enough to actually matter? In other words, if you left it out or got it wrong, could it change an investor's decision? If a massive company loses a $20 bill, it's not material. But if they misstate their annual profit by $20 million, oh yeah, that is definitely material. This quote just says it all, doesn't it? It means you can't pick the wrong policy and then just try to explain it away in a tiny footnote at the end of the report. The accounting has to be right from the get-go. A disclosure can't fix a fundamentally flawed decision. All right, so a company has carefully selected its policies. They're all set. But what happens if they want to change one? Can they just switch things up whenever they feel like it? The answer is a hard no. There are very, very strict rules for making that kind of change. A company can't change policies just because it wants to. There are only two legitimate reasons. The first one is pretty straightforward. The law changes, or a new accounting standard comes out that forces them to change. The second reason is more subjective. The company has to be able to prove that the new policy results in a more appropriate and fair presentation. It's not about what looks better. It has to be a genuine improvement. And on top of that, if a company does make a change, they have to be completely transparent about it. They need to calculate and tell everyone the exact financial impact. An investor needs to be able to look at the numbers and see how much of a profit change came from actual business performance versus how much came from just changing the accounting rules. Let's look at a real-world example here. So, Omega Enterprises changed how it valued its inventory. And what was the reason they gave? It was exactly what the rules demand. They stated, and I'm quoting here, that they believe the change would result in a more appropriate presentation. That's the high bar a company has to clear to justify a change. Whew, okay, that was a lot of information. Let's just pause for a second here and bring it all together with a quick recap of the absolute must-know points. So, here's what it all comes down to. First, policies are the specific principles and methods a company uses. Second, choosing those policies has to be guided by prudence, substance over form, and materiality. Third, changing a policy is a rare event, only allowed if the law demands it or for a genuinely better presentation. And finally, the whole point of all of this is to give a true and fair view of the company's financial health. All right, now for the fun part. Let's put what you've just learned to the test with a couple of quick questions to make sure everything has sunk in. Ready? First one's up. True or false? There is a single list of accounting policies, which are applicable to all enterprises in all circumstances. What do you think? And for question number 2, a change in accounting policy is justified when? Is it A, to comply with an accounting standard in law, B, to ensure a more appropriate presentation of the financial statement, or C, both of those? Okay, let's see how you did. The answer to the first question is false. Remember, different companies are, well, different. They need policies that fit their specific situation. And for the second one, the answer is C, both of them. A change is only okay if it's required by law or it results in a better presentation. Hope you got those right. And I'll leave you with one final question to think about. If different companies can choose different accounting policies, how does it affect our ability to make a true apples-to-apples comparison between them? It's the central challenge of financial analysis, and it's why understanding these policies is so incredibly important. Thanks for tuning in.